Energy prices are surging, bond yields are back at multi-decade highs, yet AI stocks are still powering equity indices. Welcome to vTalkInsight, Equity Pulse Daily for May 19, 2026, where we unpack how this clash between a stagflation scare and an AI boom is reshaping today's equity landscape. In the macro backdrop, the equity story is now dominated by a classic stagflation scare, higher energy prices colliding with a renewed bond sell-off. Long-dated U.S. Treasury yields have broken above previous ceilings, with a 30-year bond around 5.1%, the highest level in decades, and global yields moving in the same direction. At the same time, tensions around Iran and the Strait of Hormuz are keeping Brent crude near $110 a barrel, with little progress on reopening key shipping lanes. Oil and product inventories that once cushioned prices are now largely depleted, so any further disruption could push crude toward $150 and deliver a fresh inflation shock before growth visibly slows. If oil prices stay elevated near $120 into the second half, some projections now see global growth being revised down from roughly 2.6% to as low as 1.5%, with U.S. inflation expectations drifting up toward 3.4%. That mix of weaker growth and stickier prices is exactly what is fueling the renewed stagflation narrative and weighing on how equity investors think about earnings durability. Against this backdrop, central banks face an awkward choice on whether to lean harder against inflation or to cushion slowing activity. The Federal Reserve is widely seen as lagging behind the curve, with some estimates putting the effective funds rate roughly 2 hikes below neutral, and there is growing talk that the new Fed chair could surprise with a hawkish tilt and even a rate increase in early summer if inflation data remain hot. Markets are therefore questioning whether the Fed can maintain a rate-cutting bias when 2-year Treasury yields sit well above policy rates and long-end yields lack a clear anchor. Some houses still see scope for as many as 3 cuts later this year, but only if labor market data weaken and monthly inflation readings improve, while persistent inflation, large fiscal deficits, and rising geopolitical fragmentation are all reinforcing expectations of a higher-for-longer rate regime. Policymakers are trying to respond, with global finance ministers meeting in Paris to discuss structural imbalances and fiscal discipline, even as Europe already shows hints of the trade-offs, with the French economy stagnating, inflation back near recent highs, and unemployment above 8%. On top of that, a new Ebola outbreak in Congo and reduced U.S. support for disease surveillance in Africa add exogenous tail risks, so equity markets are watching the next inflation prints, oil headlines, and central bank signals even more closely. Despite this challenging macro mix, headline equity indices have been remarkably resilient. The S&P 500 has just logged a 7th straight week of gains, even after a one-day drop of more than 1% last week and a volatility index parked in the high teens, which together point to cautious rather than panicked risk-taking. Beneath the surface, though, the tape looks much less comforting. Only around the mid-40% of S&P names are trading above their 50-day moving averages. More stocks are down 20% from their highs than are outperforming the benchmark, and gains are increasingly concentrated in a narrow group of mega-cap technology leaders. AI-related spending is now doing much of the heavy lifting for both the macro data and the equity market, with recent estimates suggesting it accounted for roughly 80% of first-quarter GDP growth. That same AI engine is underpinning S&P valuations, and the market's focus is squarely on Nvidia, where expectations for more than 70% year-on-year revenue growth and a forward multiple in the mid-20s are still viewed by many as justified by hyperscaler demand. Upcoming Nvidia earnings are being treated as more important for near-term equity direction than several macro releases, a sign of just how dependent the rally has become on a handful of AI and infrastructure winners. That narrow leadership keeps price-to-earnings to growth metrics for the index looking acceptable, but it also magnifies the downside if even one of these bellwethers disappoints on guidance or capital expenditure trends. Europe, by contrast, is leaning more clearly toward risk-off. The Stoxx 600 is down about 0.7%, technology, Banks and luxury names are under pressure. Italian bank Monte Paschi has sold off sharply, while energy producers such as Equinor and BP are supported by higher oil prices, and defensive sectors are quietly outperforming. Travel and leisure stocks are feeling the squeeze, with airlines like Ryanair underperforming despite strong reported earnings as they pull guidance in the face of fuel price volatility. At the same time, high-yield and private credit markets are flashing early stress, with business development company shares rolling over and a growing divergence from investment-grade credit. So the combination of narrow equity breadth, emerging credit tension, and policy uncertainty makes Nvidia's results and this week's Federal Reserve minutes pivotal for the next move in risk assets. The center of that narrow equity leadership remains the AI hardware and infrastructure complex. Demand for accelerators, high-speed networking, and advanced memory is still running ahead of supply, and the market continues to reward companies that can credibly capture that spend. Semiconductor names are at the heart of this story, with expectations for further double-digit upside in stocks like AMD and consensus forecasts that Nvidia can sustain revenue growth north of 70% and potentially close to 80% year-on-year thanks to hyperscaler capital expenditure. The recent IPO of Cerebras Systems, which surged more than 60% on its debut, underscored just how strong investor appetite is for anything tied to AI compute. On the supply side, AI-driven demand for memory and data center components is prompting leading manufacturers, particularly in Korea, to sign multi-year supply agreements with hyperscalers that could see industry requirements double or even quadruple. Those contracts are improving earnings visibility and dampening price swings for memory makers, helping explain why Samsung's profitability and share price have been outpacing peers as it emerges as a key beneficiary of the AI boom. Even here, the medium-term picture is not one way. There is growing concern that exceptionally strong AI hardware orders may have pulled future demand forward, setting up a softer patch once first-wave build-outs are complete, and that as China ramps its own memory production, the sector could tip from shortage into oversupply, with valuation consequences even if today's fundamentals remain robust. Company-specific risks are also in focus, particularly for Nvidia, which faces uncertainty over roughly $50 billion of potential China sales amid local resistance and regulatory frictions, alongside intensifying competition from custom chips designed by players such as Google. More broadly, the sheer capital intensity of the AI cycle is rising, with tech giants like Alphabet shifting from buybacks toward tens of billions of dollars in new bond issuance, which increases their sensitivity to the same higher-for-longer rate regime that is challenging the rest of the market. Beyond chips, the AI build-out is reshaping power markets and utilities. U.S. utilities are planning trillions of dollars of investment over the next 5 years to bridge the gap between data center energy demand and existing capacity, and NextEra's proposed $67 billion all-stock acquisition of Dominion Energy would create the world's largest listed utility, with a diversified mix of gas, solar, and wind assets and a strategic foothold in Virginia's hyperscale data center corridor. The clearest real economy transmission of the energy shock is in global aviation. Persistent tensions in the Gulf, drone attacks on infrastructure in the UAE and Saudi Arabia, and uncertainty around the reopening of the Strait of Hormuz are keeping jet fuel prices elevated, forcing airlines to cut capacity, raise ticket prices, and, in some cases such as Lufthansa, cancel tens of thousands of flights, all of which threaten peak season revenues. Ryanair highlights both resilience and fragility within the sector. The airline is about 80% hedged on fuel through early 2027 at roughly $67 a barrel and is on track to become debt-free with a fleet of around 650 aircraft, yet it still faces rising costs on unhedged fuel, crews, and maintenance, has pulled back from giving forward profit guidance, and has seen its share price retreat from recent highs. Many European carriers with limited hedging are already trimming routes, and some may have to contemplate deeper cuts or even restructuring if oil stays close to current levels into year-end, especially with jet fuel inventories in Europe projected to drop towards single-digit days of coverage. If the Strait of Hormuz does not reopen by late summer, Route reductions of up to 15% on some European networks are being discussed, and several scenarios now flag a risk that sustained high oil could push both the US and Europe toward recession. On the consumer side, elevated gasoline prices and persistent uncertainty are encouraging households to prioritize essentials and seek more value in their spending. Walmart is gaining share through store renovations and employee upskilling. Amazon continues to leverage its scale and data advantage, while off-price retailers such as TJX, Ross, and Burlington are expected to benefit from tax refunds and broad-based trade-down, even as more discretionary names like Home Depot struggle with weak housing demand and high mortgage rates. Funding conditions add another layer of complexity for equities. A potential record-breaking IPO from SpaceX, targeting a valuation around $2 trillion with up to $75 billion in new stock and reportedly strong interest from institutions like BlackRock, could both energize space and AI infrastructure themes and absorb significant global liquidity, especially as other major tech names such as Anthropic, Alphabet, and OpenAI tap markets through large equity and debt deals, all against a backdrop of nascent stress in high yield and private credit and higher financing costs in areas like UK real estate. Bringing this together, equity markets are balancing a sharp move higher in energy prices and bond yields against an exceptionally strong but narrow AI-led earnings engine. Headline indices still look resilient, yet breadth is thin. Credit is starting to creak at the edges, and real economy channels from airlines to housing and consumer spending are feeling the strain from a potential stagflation regime. On the positive side, AI semiconductors, data center infrastructure, and utilities tied into the energy transition continue to show robust demand and earnings visibility, while upcoming corporate actions from Nvidia's results to the SpaceX IPO and the NextEra Dominion deal will help clarify how durable that growth really is in a higher-for-longer rate world. From here, the crucial signals are the path of oil and the Strait of Hormuz, the tone of the Fed minutes and any shift in policy bias, the reaction to key AI earnings, and whether stress in high yield and private credit broadens into a wider de-risking across equities. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.